Welcome to our comprehensive guide, Investing for Beginners. Starting your financial journey can be intimidating, but we're here to break down everything you need to know. Let's start with the basics and introduce you to the world of investing. At its core, investing means putting your money to work for you. It's not just saving. It's actively seeking growth to beat inflation and achieve financial freedom. The best time to start investing is now. Time is your biggest asset, allowing you to maximize the power of compound interest and protect your money's value against inflation. Now that you know why to start, let's cover some fundamental concepts that drive the investment world. One of the first concepts you must understand is the relationship between risk and reward. Generally, higher potential returns come with higher risk. Compound interest is often called the quote-unquote snowball effect. It means earning returns not only on your initial investment, but also on the accumulated returns from previous periods. To invest effectively, you need a clear target. Let's discuss how to set meaningful financial goals. Distinguish between short-term goals, like a down payment in 3 years, and long-term goals, such as retirement. Your time horizon will heavily influence your investment choices. Understanding your personal risk tolerance is vital. Ask yourself how you would react if your investments suddenly dropped by 20%. Your answer will guide how aggressive or conservative your portfolio should be. There are many avenues for investment. Let's explore the most common types available to beginners. Stocks offer ownership in companies. Bonds are essentially loans you give to entities, and mutual funds pool money from many investors to buy a diversified portfolio. Beyond the basics, ETFs and index funds offer diversification with low fees. Real estate is another popular choice, providing tangible assets and potential rental income. Ready to open your first investment account? Here's how to get started. First, you need a platform. A brokerage allows you to trade yourself, while a robo-advisor does the heavy lifting for you based on your risk profile. When opening accounts, prioritize tax advantages. Traditional and Roth IRAs, as well as 401k plans through your employer, offer significant benefits for long-term growth. Once your accounts are set up, what's your game plan? These core strategies are ideal for new investors. Dollar cost averaging, or DCA, means investing fixed amounts of money at regular intervals, regardless of the asset's price. This reduces the risk of buying at market peaks. Diversification is essential. Don't put all your eggs in one basket. Spread your investments across different asset classes and sectors to mitigate risk. The investment journey has pitfalls. Here are a couple of common mistakes you should learn to avoid. Avoid emotional trading. Panic selling during market dips or chasing quick gains based on hype usually leads to poor outcomes. Stick to your long-term plan. Finally, be mindful of fees and expenses. Over time, even small fees can significantly eat into your returns. Look for low-cost funds and brokerages.